We're of the view that investors need to be building a foundation of stability amidst this uncertainty. So things like hedge funds, gold, we think are things that we've been increasing positions in over the last few months.
Is dollar going to continue to remain strong, and how problematic is that going to be for this region from an outflows perspective?
We think dollar continues to remain strong at least until the German elections in late February from here. If you see a lot more fiscal flexibility in Germany, that would allow a bid to come back into Europe. But the strong dollar is a problem not only for this region, but we think for the world and for the United States here. And certainly the incoming administration would love to see the dollar weak. Unfortunately, the economic differential suggests the dollar is going to remain strong until something changes.
So you're arguing for a more defensive tilt to allocation until we have greater clarity. Are there, in this region and globally, Norman, Trump-agnostic trades or narratives that are capable of rising above this political noise?
It's not so much I would call them Trump agnostic. They're trades that we think are mispricing what we do believe is a growing inflationary environment around the world. We do think bond yields, which have already started to rise, will probably go challenge 5% in the U.S. dollar market later this year. We think the pullback in gold, for example, that we've seen since Donald Trump's been elected, we think that's an opportunity for investors. And so there are spots around the world where investors can find things. But unlike, let's say, the last year, this is not going to be a year where you just kind of put money in and it goes up.
That's interesting that you're calling for a retest of 5% on the 10-year yield. Is that going to be a disorderly move higher in yields?
I don't think it has to be a disorderly move. I think what we've been seeing right now is, again, inflation is bottoming. We think it's going to start to pick up later this year, and we think the market will need to price that. We think, as we're seeing, the job market is quite good. We think economic growth is quite good, and we think that's inconsistent with yields of 4% or so in the United States.